Good morning, everyone. My name is Mei Gao. I'm a partner at IDG Capital. I'm delighted to welcome you to the first panel of the TCFA conference on global economic outlook. First, let me just take a brief moment to introduce our distinguished panelists. First, we have Mr. Bruce Kasman, Chief Economist and Head of Global Economic Research at JP Morgan and Chase. Next to him, we have Mr. Chris Varvaris, Vice President and Co-Head of U.S. Economics at Macroeconomic Advisors by IHS Markit. Last but not least, we have Mr. Sergey Lano, Deputy Chief Economist at the Institute of International Finance. Our panelists have a wealth of experience and knowledge both in the public and private sector. You can look up their bios in the brochure. So Bruce, Chris, and Sergey, S&P is up more than 23% year to date. There's certainly lots of optimism in the financial market. But for the real economy, 2019 has been a little bit more challenging. The ongoing trade tension between China and U.S. has certainly tamed business confidence and depressed global trade and hurts export-oriented economies. On the other hand, we have very, very accommodating monetary policies. Actually, so far this year, more than 30 central banks have eased around the globe, and in the process, driving $12.5 trillion of debt into negative interest rate territories. So the result is subpar growth, depressed global growth, weakened inflation, and subdued manufacturing activities. So actually, just about 3 weeks ago, the IMF took down the global growth number for 2019 by 30 basis points to 3%, the lowest since the financial crisis. So going into 2020, what's your outlook for growth, for inflation, for the job market, for monetary policies, and interest rates? Let's start from Bruce.
Okay, so sorry. So I think the right way to look at the world today is to understand there's a tug of war going on, and you know, a big part of that tug of war on the negative side relates to geopolitical drags coming from the U.S.-China trade conflict, drags coming from Brexit, a couple of other things perhaps at a smaller level. And what I would emphasize is the effects that this is working through is not direct. It's not about higher tariffs. It's not specifically influencing the China supply chain in a way that's driving the big part of the global outlook. It's the indirect effect. It's the effect that it's having on companies who are becoming more uncertain about how the rules governing global trade, how the rules in terms of how politics interacts with economic institutions and relations is playing out. And we can see that very clearly during the early part of 2019. We began to see business spending weaken alongside a pretty broad-based and sharp fall in sentiment. Actually, first half of 2019, global growth was at trend. It wasn't actually weak. It had slowed from a very strong 2018. But I think what's also happening now as we make our way through the second half of the year is we're seeing a broadening out of that weakness. We're seeing job growth slow broadly across the world. And I think we're starting to see the consumer, which has been really carrying the global economy for most of the last year, also cool off. But there's another side of this, as you were mentioning, which is the supports that are coming from policy. And policy is constrained in a number of places, but the Fed, having first pivoted and then provided easing, Chinese policymakers moving on broad fronts, have been, I think, very important in both directly supporting growth and also indirectly bolstering confidence and financial market conditions, where I think the most important place to be focused on there is how well credit has continued to flow normally. That's, I think, a huge event for limiting the damage and reducing the risks of magnification of slowing as it works through the system. So this is the tug of war we're in, and I think it's a mistake to believe that this is going to lead either to a recession or a quick turnaround in growth. I think, unfortunately, the environment we're in now does suggest continued sluggish growth for a little while. But I think at the same time, our view is that if we're willing to believe that there will be a truce in U.S.-China trade, if we're willing to believe we can avoid the worst-case scenario of a no-deal Brexit, that as we move through time, and time for me is somewhere on a horizon of about 6 months, that not only are we going to start to see the global economy do better, we're actually going to start to see it do a lot better because the policy supports will build. There'll be a sigh of relief in terms of the sentiment drag as we see the worst fears not being realized. And as we sit here today, we're watching leanness begin to become a theme in terms of business spending, both in terms of CapEx and also in terms of the inventory picture. So in our frame, we see this ultimately as playing out as the third wave of this expansion. We had a wave down in growth around the European sovereign crisis in 2011 and 12, and then we had a short-lived rebound in 13 into 14. We had a wave down as the unwind of commodity excesses and EM credit tightening took global growth slower, was a fairly powerful disinflationary drag in 2015-16. And this wave down that we've been experiencing for the last year, we think is going to be followed by a leg up. I'd like to just, if I could, just end by saying, if we are actually getting through this without the global economy faltering and going into recession, I think there are two big challenges we have to recognize lies ahead. And they are first and foremost the corporate challenge, which is equity markets are doing well, but corporate profitability is not doing well. And the weak supply side performance we've been seeing in the US and across the world with productivity growth weak, demographics not helping us, is starting to create pressures as labor costs are starting to move out of line with productivity performance. That's traditionally a vulnerability, and how well we can navigate through that in terms of corporate performance, I think has a lot to say about how long this expansion is going to last. And then finally, we've got the reflation challenge, which is growth is going to pick up in 2020 as we expect, but it's not at all obvious that that's going to be followed by consumer price inflation getting back to where central banks want it to be. The Fed is trying aggressively to deal with this issue through its makeup strategies. I think there's limited benefits that's going to have in the short term, particularly with the legacy of weak global growth behind us. Other central banks, the ECB, the BOJ, others are more constrained and quite frankly are not as committed to working hard on this front. And I think, you know, the near-term picture is still softness. The 2020 picture, I think, is going to surprise people to the upside. But there are some underlying and very serious macro challenges that are going to be faced here. And I think without taking up too much time, I'll just stop on that front. Thank you.
Thanks for your insight. We certainly hope that we will see above trend growth again in 2020. So Bruce mentioned the downward pressure to corporate profits and the reflation risk. I remember last time this year, everyone was talking about how many times the Fed was going to cut interest rates. And in August 2019, people are talking about when, if not if, US 10-year Treasury was going to hit 0%. And recently we saw the Treasury yields recovered to 1.9%. So Chris, what's the biggest risk you are seeing for 2020?
Well, if I may, I want to echo Bruce's relative optimism. I think it's most likely that a recession will be avoided. So the base case is no recession. It is lackluster growth. I think some of what we're seeing, the weakness today, is there are a number of special factors, and some of them are around a global inventory cycle that I think we're just beginning to see somewhat of a bottom being put in the manufacturing sector, certainly in the US, and if you squint, you might even be seeing it in Europe. And so the best base path is really relatively tepid growth going forward. Now, there's some good reasons for this. When you look at where we are in the United States, we're at capacity, basically. We have a 3.5% unemployment rate. Our trend growth, our potential GDP growth is probably around 2%. So if we're looking for above trend growth, we're still going to be looking at tepid growth. It's going to be in the 2 to 2.5% range. And that's our base forecast for this year. And growth has to slow below trend, we believe, because otherwise inflation will gradually creep higher to levels that at some point will become unacceptable to the Fed. So the risks that we face in the United States, in any case, we view as mostly imported risks. A blow up in the trade tensions to a full-scale trade war, bringing capital flows into the picture would be a major disaster, and I think that is probably risk number one, because in part because of the unpredictability of the people who have their hands on the levers. A second risk would be that Europe is unable to revive, and some of the weakness in Italy spreads more broadly, and that weakness would then spread across Europe and obviously pull down the global economy. Issues with a hard Brexit obviously are another major risk that we face. And then can the policy moves in China be effective in reviving the economy so that we don't see a progressive slowing in growth from 6.5 through 6 to 5.5 to 5? I think those, for me, those are the biggest risks that we face. And it says, in terms of the pivot, the Fed pivot, this was the major motivation for the pivot, that set of risks. Now, one of the things we have to be aware of is when we take out, some have described what the Fed did is it took out an insurance policy against these risks. I don't really like that analogy. It acted in a way to reduce the probability that the risks would occur. That's not what insurance is, okay? It took proactive steps to reduce the likelihood that the risks would occur and to mitigate the impact on the U.S. economy if, in fact, some of these risks did materialize. So going forward, I see the Fed as being, we use the term data dependent. If the economy progresses in the way that Bruce described, and as we also expect, no recession, some resumption of growth as we move into early 2020, then the Fed obviously is done. And I think they made it pretty clear that they have the same view. If the economy progresses along the lines of what is now the consensus forecast, they're done easing for this cycle. And the question is, what happens next? And we do expect that there'll be, again, avoiding recession, the economy will pick up sufficiently that the Fed will be having to raise rates. Maybe not in 2020, but by the time we get to 2021, we could see short-term rates rising. And that, of course, will be preceded by a broader realization within the financial markets. Long-term rates will begin to move up, and we'll see a 10-year Treasury once again above 3%. So not only at 190, but probably at 290 and 3%. But yeah, so the overall view of the global economy is there are risks, but we don't have the kinds of things, the catalytic events, except for maybe one big policy mistake. We don't see the likelihood of these catalytic events that would throw the economy into any kind of a deep global recession. It'll be more along the lines of some kind of a fizzling out, a soft period of soft growth, maybe even a mild saucer-shaped recession.
I certainly like the optimism on this panel. Chris, you mentioned imported risk to the U.S. economy. U.S. is definitely the bright spot across the globe in terms of growth. So Sergey, sitting at the Institute of International Finance, what's your outlook for global growth across regions?
Mm-hmm. So good morning, everyone. I think our outlook is also positive, but I think the three of us are positive in the spectrum of what people are saying these days. If you look at global growth in absolute terms, this year it will be the slowest since 2012, right? And 2012 was the euro area crisis, so growth has slowed. Now, the reason why I think a lot like Bruce and Chris that the downside is relatively limited is that if you look at what's going on, there's been a lot of emphasis on manufacturing, which is not doing well, and it's not doing well almost anywhere. It is in Vietnam, by the way, which is one of the countries that sounds as a possible alternative to redesign supply chains, but it's not big globally, certainly. But what's been happening is that services, the services economy, which basically is 60–70% of the global economy, has been quite resilient. The spillover from weak manufacturing is there, but is relatively contained. So unless you assume that something bad's going to happen to services, the case for a recession in the US, the case for much weaker global growth, we don't think it's that easy to make. And then in the US, I think people sometimes forget that last year was unusually good because of tax cuts. And that was a one-off, that you do it once, and unless you keep cutting taxes, the impact on growth is not going to last forever. So for example, you take job creation this year in the US. Yes, it's not as good as last year, but if you compare to 2017, in services, for example, things are going very well. More jobs were created this year than in 2017. Manufacturing, again, is not great, but it's not 100% of the economy, and the dollar has been strong, so it's not an environment conducive for manufacturing job creation. Now, May, on your question on what this means for interest rates and for markets, one thing I would like to note is that we think that when it comes to long rates in the US, they've been increasingly more driven by global events, basically the trade war, not so much by surprises to employment creation in the US or not. I think they've traded a lot like, do we think trade is going well or is not? And I think the increase we've seen to 1.9 in the recent days and weeks, I think is built a lot around the expectation that you do have a trade truce. Now, I also find it interesting that all along there have been many trade tensions, but the signal from the market has been a bit mixed, right? In terms of rates, yeah, clearly people price the Fed to cut a lot, and the Fed did. And you look at the yield curve, and it's not telling you things will be great, or not for quite a few months. But the stock market this year has been quite good at all times. And if you look at manufacturing firms across the world, in all kinds of countries, Germany, Korea, China, the US, they have not underperformed the overall market. So the equity market is not really pricing at the moment bad outcomes when it comes to trade. There's been a different story for some time when you look at what markets price in terms of what the Fed and others will do.
Thank you. Just now you mentioned the US-China trade tension. I guess not a single day goes by without a discussion on that topic. Over the weekends, Chinese officials confirmed that they are US and China are finalizing the phase 1 deal. But what does it really mean? Does it mean just a temporary pause in tariff escalation, or does it signal a much more positive, favorable relationship going forward? How do you see this relationship pan out? Bruce?
I hesitate to say anything with a high degree of confidence on this, given how little expertise I feel I have in terms of understanding both U.S. and China politics. And obviously, the other issue we have to deal with is there's a U.S. election coming up. So as we look out beyond the next year, there certainly is a possibility that the political landscape will change. Perhaps I think something I feel a little bit more comfortable on is trying to understand where the dynamic is right now and why we will likely get a phase 1 deal, but a phase 1 deal which won't end tensions. I think we have to understand that from the U.S. point of view, the freedom that's been given to Donald Trump to act in aggressive manner really does reflect the fact that there are multiple interests that have come together to believe that China policies with regard to trade, intellectual property, and more generally its development path is posing a threat to the U.S. This is not about trade deficits in a narrow sense. So there has been a sense that it is appropriate to confront China, and it's been appropriate to ask for changes on a broad-based manner. Now, there is, I think, a very little chance that in that broad ask that China can agree, because a lot of what the U.S. is trying to change reflects an attempt to shift China's policies in a fairly fundamental way. So from our point of view, it's hard to get resolution to this conflict because the interests in the U.S. are broad. It includes defense, it includes technology, it includes broad interests in the labor institutions as well. But at the same time, I think both economies, both interests in U.S. and China, understand the damage that is being done now and the threat to the two economies, which are making both sides uncomfortable. So I think in that context, the idea of a truce, the idea of a phase one deal where there is a partial agreement that allows the threats to their economies to be reduced makes sense. And it seems to me that's where we're moving towards as we see a deal being struck sometime before year end. But to think that this would reflect an end to the conflict, I think is a mistake, although I certainly don't know how the conflict is going to evolve from here. The other thing I would just want to connect it to is, again, the point that if you look at what damage is being done to the global economy, it's not because of tariffs. The increase in tariffs on U.S. consumers is not even worth talking about in terms of a macroeconomic effect. And while the effect of tariffs on the Chinese economy and the Asian suppliers of that are perhaps more interesting in the way the supply chain is being disrupted, that's not really the reason why the Chinese economy has been weakening. It is the effects that are happening on business sentiment. It's the effect of the way that people are thinking about how the rules of the game are changing. And if we enter a truce, but one that isn't a resolution, I would emphasize that we are going to get some relief, as we're seeing already in financial markets as they build in some of that expectation. But that relief is going to be limited. The rebound we're expecting in global growth is more about the fact that we think that businesses around the world, and I'd emphasize this is more likely to be concentrated in Asia and other countries connected to the global manufacturing sector than the U.S., that these companies around the world have pulled back in a way that if we do get a truce, they'll feel they have had to do have done more than is necessary. And the combination of that with policy supports that are building, that's what gets you the lifting in global growth next year.
What's your take, please?
So, also disclaimer, I think I'd put, more so than Bruce, I'd put myself in the category of a rank amateur in terms of understanding the politics and the trade issues. However, amateurs sometimes get it right, so let me throw this out there. I think there's a political imperative in the United States to get a deal done. The trade tensions and the tariffs have harmed the economy. Bruce is absolutely right. The tariffs themselves, the direct effects we view as almost lost in the rounding, quite small. However, the financial market effects, the sentiment effects are likely much more important, and we think do play a role. In particular, we did do a study where we looked at whether U.S. investment and particularly manufacturing industries within manufacturing that are open to trade in the U.S., what have they done with their capital spending over the past 3 years? And in fact, there's an identifiable slowdown in capital spending that we tie directly to the increase in trade policy uncertainty using some measures that were developed at the Federal Reserve. And we view that as possibly holding down CapEx by about $100 billion, 0.5% of GDP. And to the extent that we get a deal and that this sort of uncertainty that's impacted business decision-making is released, that you could see some upswing in activity, certainly some release of capital spending that might have been suppressed as a result of the trade tensions. Now, I don't think any of this is lost on the politicians in the United States. And of course, our president is amazingly good at taking a defeat and calling it a victory. So to me, this gives us an opportunity for a deal which will not be much of a deal. There will be some concessions on both sides, presumably, but it will be touted as, I did it, I slayed the beast, and aren't I great? So I think there is an opportunity for some sort of a deal that will release the tensions and relieve the uncertainty. And when we do that, the spring that's been depressed will come back. And so that $100 billion of CapEx, it won't come back immediately. I've described this as a game of Russian roulette. You don't know whether your industry is going to be the next one that's going to be subject to some sort of retaliatory tariff. And that has a freezing effect on business decision making. And if we can eliminate that and lift that pall from the global economy, it obviously will have a beneficial effect. Will it be big? Will it be little? I don't know, but I think the direction is positive.
Okay, let me try to answer this question in a completely different way, because I'm certainly not the one who can guess what will happen next, especially on the US side. But so imagine that trade tensions were a temporary shock, right? That it's going to go away. What would a country suffering from it do if policymakers know what they're doing and they want to stabilize activity in the face of temporary shocks? You would ease policies, right? If you can, you would try to maybe spend a bit more, cut interest rates, do all these things. Is China doing a lot of this, thinking that, okay, this is going to go away, so let's cushion the impact now? I think that compared to 2015-16, when China was also slowing, probably more than headline GDP told you, there was a lot of policy stimulus, right? And you could see it a lot in credit growth. It increased really fast. And then this lifted China, and it also helped the global economy a lot. This time around, are we seeing many policy steps in China? I would say no. We are seeing very calibrated policy response to manage downside risk. But we think that the Chinese economy slowed mostly at the beginning of last year, and that had a lot to do with deleveraging. And that since then, policy has been such that trade tensions affect the economy, and there's a bit of an offset, but not a lot. So China is letting the economy slow, which is not what a rational policymaker would do if you think that the shock is temporary. So my reading from Beijing's reaction is that they expect the trade theme, I would say, maybe it's not tariffs in a year's time, that it will remain an issue to grapple with in the global economy, in China and in the US.
Thank you. As a Chinese Americans, I certainly hope that President Xi and President Trump would reach some sort of agreement. Yeah. So, but I salute you guys that have to make prediction in an environment that when a single tweet can change the trajectory of the global economy and the financial market. Speaking of the financial market, there was one event in September that shook market participants. That was when overnight repo rate hit 10%, and the Federal Reserve has to hastily intervene. Having gone through the financial crisis myself, I remembered in August 2007, the first run on the repo market as a prelude to the financial crisis. So Bruce, JP Morgan is one of the most dominant players in the repo market. And do you think there is hidden risk that we are unaware of? How do you think we can fix the repo market? Also, you started your distinguished career at the Federal Reserve. How would you rank the Fed's performance in that dealing with the repo crisis?
So the first and most important question here is, does this reflect hidden risk? And I think the simple answer is no. I think the problems in the repo market are plumbing issues. Plumbing issues can be important, but the contrast between what's happening in recent months and what you saw happening in 2007, which I think you're 100% right in highlighting that in the summer of 2007, when we started to see the problem in funding markets begin to emerge, it was a signal of the problems ahead. That was a credit problem, and it was clearly signaled as you looked at credit indicators at that time that the market was beginning to get more uncomfortable with counterparty risk along a whole range of banks and other players in the system. That's not what's going on here now. Now, I think the simple point about the repo problem is that it relates to the fact that the Fed has been draining reserves from the system. It does not have a facility in place to limit temporary upward pressure on overnight rates in the repo market. And it underestimated the potential for upward pressure in a world in which regulatory change has limited quite significantly the willingness of banks like ours and others in the market to actually come in and limit volatility in that market when it took place. So I think it is appropriate to say that this is a problem which in some ways could have been anticipated. I think it's appropriate to say that the Fed was in some ways a little bit flat-footed, probably would be the word I would use in terms of how it responded to it. And I think it's appropriate to say that we need to have more structural changes here in the way that the Fed manages overnight interest rates to deal with this, some of which they're making choices right now in the form of shifting the way the reserve in the balance sheet are going to be maintained to a higher level to create a space. But I think some issues around the possibility of having a standing repo facility and possibly even changing regulatory matters, but I'm not disinterested in that as a JP Morgan employee, so I probably shouldn't jump in about the wisdom in doing that. But in the end of the day, does this have any consequence in terms of the macroeconomic outlook? I would say no. Does it pose a risk from financial stability point of view? I would say no. Has it kind of blemished the Fed a little bit in the market's mind and its kind of inability to anticipate and respond aggressively enough? I think yes, but I think in the broader scheme of things, this is probably not going to be a topic that we're going to be focusing on in 2 or 3 years' time.
As someone that has been involved in the fixed income market for more than 20 years, the repo market is definitely close and dear to my heart. I certainly hope that the Fed would take necessary measures to ensure its proper functioning. So Sergey, actually lots of people mentioned the increase in Treasury supply to finance the budget deficit as a reason for the blow up in repo rates. So you can see since 2002, the US actually, we witnessed a resurgence of the twin deficits. The deficit was $984 billion for 2019, and is expected to hit $1.1 trillion in 2020. On the current account deficit side, it's not that much better despite Trump's tariffs. So you have lots of experience in international finance. How do you think the U.S. twin deficit would have an impact on the dollar and on global financial market and to global economy?
Okay, so this is an issue that's been discussed many times in the last few years, as you say. And what we said last year when the deficit was widening because tax cuts were coming online, and we were in a world where overheating in the US was more of a possibility. Then we broke down the analysis in 2 bits. One is the current account, one of the 2 twins. In the US, it remains in deficit, but it's been changing a lot in a structural way because the US is becoming an oil exporter. So we think that even though fiscal deficits mean that the government saves less, there are often offsets from other sectors, and the current account is changing structurally. So we are not sure that bigger current account deficits in the US would mean dollar depreciation, which would be the natural reaction of the currency. The government spends more, this increases domestic demand, imports go up, the current account deficit widens, and you need depreciation to correct that. If anything, we think that where there could be some action is on interest rates, but yet I'm a bit reluctant to make a call here that is very clear because, first of all, the policy consensus is kind of evolving toward this view that policy stimulus, fiscal stimulus is the right thing to do, perhaps in a coordinated way. So I'm wondering if the market and general reaction to fiscal stimulus would be more like, okay, That's the right policy step. We're running out of ammunition with monetary policy. So yes, it does result in higher interest rates, but it's good for risk assets, it's good for the S&P 500. So overall, would it be a negative? It's not totally clear.
That's good to know. I believe most of us sitting here, we're all dollar holders. And so it's election seasons again, and politicians like to point to globalization and unconventional monetary policy as a root cause of income inequality. But increasingly, we're also seeing debates among the policymakers, whether it's the central bank's responsibility to address sentiments in the financial market, and whether it's the central bank's job to extend economic expansion to perpetuity. In September, we witnessed the Chairman's appointee to the ECB board's resignation as a backlash against the latest stimulus measures. And on this side of the Atlantic, we're also seeing some of the FOMC members are increasingly vocal in voicing their dissenting view. So Chris, according to the Federal Reserve Bank of Chicago, you're one of the best macroeconomic forecasters. So can you pull out your crystal ball and tell us how this contention is going to affect monetary policies going forward?
So Chicago Fed's analysis proves, as we all know, even a blind squirrel will find a nut once in a while. So you know, it's really hard to say. We've moved from a period where the Federal Reserve Chair ruled the FOMC with an iron hand, and we heard very little from other speakers, and if we did hear from them, we knew that it really didn't matter because we were going to do what Alan Greenspan wanted to do. And we've progressed through a very different set of chairs recently who are much more inclined to want to build a consensus on the committee and absorb more of the views from the committee, and that's where we are today. There's sort of very important consensus building that the chairs have been involved with, but they've also been very compelling. So when you think of what Bernanke was able to do and what Janet Yellen was able to do, they were able really to lead by marshaling all the analysis of the staff and their intellectual capacity to push the consensus sort of where they wanted it to go and help form that consensus. Now, not everybody goes along, and in this era of transparency, we hear lots of Fed speakers and they're saying different things, and it sometimes confuses markets. But I think we need to realize that there is a core, and the core and what we're seeing from Powell is a lot of care to try to express the views of the consensus and not step too far out from where he perceives that consensus to be. And I'm having a senior moment. There was a particular thing during the press conference where it was calling out for him to say something, and he sort of hesitated and sort of said it in a different way. I forget what the issue was exactly, but it was just very clear that he wanted to just stay right on message with where the committee's consensus was. And I think that's what we're going to hear. The fact that we get dissents and that we hear people concerned about emerging bubbles, we hear others concerned about the persistent weakness in the economy or inflation and downside risks. It's just really, you know, I don't think that matters so much for the actual outcome of policy.
Thank you. Bruce, do you have something to add?
I just wanted to tie a little bit together this conversation on policy to basically make a simple point, which is if we take what seems to me a relatively similar view by the three panelists, unfortunately I haven't found anything much to argue about yet, but I think it's pretty straightforward that over the next year we're going to see policy shifts in a relative sense that's going to create downward pressure on the US dollar. I think that's about as easy a call. I mean, part of this is the simple fact that when global growth picks up, if it does, there tends to be a tendency for capital to flow outside of the U.S. And I think it's very clear that if we get a pickup that's led by businesses breathing a sigh of relief, the beneficiaries here are going to be capital goods producers and countries that are more heavily concentrated in the industrial sector. On the fiscal policy side, the U.S. has a big deficit, but it has a fading stimulus. The stimulus that's building in the world on the fiscal side is largely in Asia, and I would take a little bit issue with Sergey because I think China is actually doing more than people appreciate with a still fiscal stimulus next year, and that's being complemented by easing in India, in Korea, in Malaysia, and in a couple of other countries in Asia. On the monetary policy side, the Fed has stopped easing, but it certainly, I think, is in the midst of this pivot towards a makeup strategy. So the idea that it will remove the policy stimulus anytime soon, I think, is very low. And I think all of those things combined with the dynamics on the politics side with the election coming up and the U.S.-China trade deal, I think all argues that when we start to see the turn in global growth, this is a very clear message towards a weaker dollar in global markets.
Thank you. I would probably echo Bruce's view on the downward pressure on U.S. dollar. In 1960, U.S. accounts for 47% of the world GDP, and that number stands at 21% now, and is projected to decline to 12% in 2050. So it will be interesting to see how the U.S. is going to sustain its capital flow with diminishing share of global economy, and in an increasingly deglobalized world. And I think we have time for one question.
Yeah, this is Hui Ding, and I'm an associate professor, and I'm interested in this topic. So could everybody use one sentence to describe what do you think about the relationship between China and the United States in the future, in the near future, like in 1 to 3 years? Thank you.
A relationship that continues, but as many relationships, is not an easy one at all times.
Sounds like a marriage. I think a relationship that will be characterized by continued healthy competition along many dimensions: economic, political, diplomatic.
I think it's central to the outcomes for the global economy, and I think there's enough conflict embedded in the relationship for it to be a potential source of problem.
Thank you. Thank you, everyone. Let's give a round of applause for our panelists.